Hello and welcome to the Durham Talents Channel. My name is Jesse Durham. For today's roundtable, we're going to be having a discussion on policy design for implementing the infinite banking concept. This is a very relevant subject for so many folks that are vetting the concept, and even for folks that have already implemented. I know that I design policies that I buy myself differently now, knowing what I know after implementing the concept for a decade. We had a great conversation, and I hope that you enjoy. Well, let's jump into it then. Let's jump into this discussion around policy design. Let me give a bit of a personal reflection here real quick to set the stage. So recently, meaning within the past year or less, I've acquired two more policies in my own system, okay? I got another policy on myself, on my life. So I'm the insured, but I'm also the owner and the payer, right? And then we got a policy on our fourth child. So we bought an adult policy, we bought a juvenile policy within our household, even within the past 12 months or less. And I can just tell you that the policy that I got on myself is a kind of a policy, a type of a policy that I wish I would have gotten years and years ago. I've been implementing this concept of infinite banking for 10 years, right? No accident. So this summer is going to be 11 years, more than a decade. And our child's policy was also structured, it was also designed in a way that's different than the first three policies that we got on our three older children, because I just know some things, think about some things differently now. So I'm saying it matters to me, policy design. But I'd also maybe like to preface by saying that, my oldest policy is perhaps not the fanciest, but boy, is it a workhorse when it comes to the banking that I've been able to do with it. So there's this spectrum, and we're going to get into it. I'm saying it matters to me personally, it matters to me professionally. When someone decides to work with me, I can't wait to hear what y'all have to say as well. All the professionals that you are in this space, they're going to be getting a custom designed policy. I do not have a cookie cutter approach when it comes to policy design. So personally, professionally, just trying to make some prefacing comments. Let's get into this discussion around policy design. The joke of Nelson comes to mind of, I know what to do, but I don't know where to start. Like there's so much to say about policy design. I have some thoughts, but maybe I should ask y'all for y'all's. Do you have any prefacing statements that you would even make right out of the gate? Something burning that you would want to say on the topic of policy design before we get into the nuances?
I'll jump in and just say that when we talk about the infinite banking concept, a lot of talk in the space does end up at some point around policy design. I'm in a number of different Facebook groups, and you see some stuff about it, things like that. What I would say is the most important thing to keep in mind with this whole process, this whole concept, is the process. It's the process of becoming your own banker, the process of retaking the banking function. That is the most important part of this entire thing. The policy is simply the tool in which you utilize to make it happen. So most of the time, if especially, I mean, you could use really an all-base design policy and still make it work for banking, depending, especially if you're using a mutual company. Is that the desired approach? Probably not. But the fact remains that you can still use it in that manner. So it really comes down to making sure that first and foremost, we understand our mindset and that our thinking is constantly being rethought. When we do that, then we can get into some of these more specific areas about the particulars of the design of the policy. And I think anybody needs to make sure that if you're going to talk policy design, and this is really, I would say, even for the average person, know what's happening when you're doing A, B, C, or D within the design of the policy. And you should be getting that information from your agent. You should be talking about those things so that you understand what's actually happening. Because there's no free lunch. It really is an engineered actuarial based product. So we have to make sure we understand what each of the levers are that we're pulling. And
Mhm.
once we know that, then we can talk some of the specifics. So I'll just kind of open it with that, I guess.
I love it. Product versus product is a great filter to look at this whole discussion because I don't mind how nuanced or detailed we get in the policy design conversation. Y'all are going to go where you want to go. I have some things that I want to bring up. But remembering that infinite banking, that is a concept of process, utilizing the product. Okay, so something you said there, Rob, makes me want to, because I want this to be somewhat cautionary, right? Knowing what I know now, I've said that I would have my older policies be different if I could, even though I've used them for so many things and it's been great and wonderful. Folks are going to hear a very wide range of language around policy design that is designed to, attract them, market to them, educate them. All right. I'm not trying to be derogatory towards anybody, but there's going to be language out there about, and some of it's erroneous, some of it's misleading. I actually strive to address a lot of that on a series that I have on my channel called The Myths, the Mysteries, and the Misconceptions, right? Whether it's something Dave Ramsey says, whether it's something Susie Orman says, whether it's something that, a generic or a general practicing insurance agent or advisor is purporting, or whether it's even somebody in the infinite banking footprint. So, some language that sticks out to me, I'd love to hear what maybe y'all have noticed out in the field, but language like efficient policies. I think it begs the question, well, what do you mean by efficient? Okay. Or I've heard language about max funded, overfunded. That's some language that's floating around in our space right now. Can y'all think of any others?
Level premiums and what exactly does that mean?
Mm-hmm. Mm-hmm.
What does level mean? Because that's an industry jargon
Right.
that gets tossed around. So I think that should be more fully explained.
I love it. Okay, thank you for that one, David. So here's the problem, or could be, it's just part of the field, right? Is I strive to use exact language that's technical and true, but also I'm trying to reach the common man. So that means I want to use common everyday language as well. So finding the balance between, well, I'm trying to be exact and use the terminology as it should be, when it should be, et cetera, but also in a way that's plain English. So level premiums is another great thing to bring up, or anything else that's jargon,
Right.
like you put it.
What I always what I strive to continue to make it we complicate things, I think, as practitioners at times, at least I do. So the idea of, using words like overfunding or, using words like PUA, like to me, it just should be a simply like, because we're teaching people to become their own bankers, because everyone at the end of the day is a banker, whether they realize it or not, is that money that's being deposited somewhere at the end of the day should really be kind of the words that we should be simplifying and breaking it down for people that are watching things on social media and other platforms, because at the end of the day, it's just where are your dollars, how is your how are you flowing your dollars through your own personal system? So, when William talks about, dump in and such, it's really just a large deposit, just like a large deposit you would make in your own your own banking system that most people that we come across are traditionally using. And so I think it's important for us and for the viewers to understand that you're going to hear a lot of jargon. And in my opinion, jargon is there to make the person that's speaking sound, let's say that they have a technical advantage, that you want to open up your listening because this person speaking about, some higher level kind of concepts I've never heard of before. Let me pay closer attention. But at the end of the day, it's really just these are simple things, simple concepts. I'm self-professing right here that I can complicate things with a lot of acronyms. So just wanted to leave it at that.
Well, I think the deposit example then is a good one that I would run with, because is paying a premium like a deposit? Is it similar in aspects? Yes, it is. But that's also, though, David, one of the areas where I want to be particular, and I'm going to use the word premium over and over and over again, because I do want to remind people, I do want to drive that home, I do want to be exact there. So conceptually, I want them to understand that paying a premium has its similarities to putting a deposit at a conventional bank. And yet it is very different. I mean, again, so we could talk through the similarities, right? Like if you give money to a bank, it's not your money anymore. The bank owes you, is what that relationship looks like. Just like when you pay a premium, it's now the insurance company's money. They are a business. You paid them for your good or service. Your good was the policy contract. That money's not yours either, but they owe you some things. Now, right there is where the difference is the advantage is, with the conventional bank, it's just, well, they just owe you that money. Maybe some pittance of an interest, that you'd be taxed on it, but it stops there. No death benefit associated with it, no compounding cash value associated with it, no dividends where you're participating in the productivity and the profitability of that company, and ownership and control, lots of features. But that's one area that where I'm saying that I think there has to be some pushback on jargon that's not industry jargon, but that it could be too loose at times, and maybe misleading to folks. So I don't know. Let's try and maybe see if we could align ourselves on some filters. I'm curious about that. I think Rob gave us maybe the best one that could have been done of process versus product. We love talking the process all the day long, and I don't mind us interweaving that into us talking about policy design, but I definitely want to talk about policy design. So let me tell you some things that I've seen, and I'd love to get y'all's perspective on this. Both in my personal journey and more so now in my professional journey, what I've seen in the marketplace is some folks, of course, only have a traditional understanding of insurance. They might use the words infinite banking. They might use the words high cash value. They might use some buzzwords that's trying to indicate something that isn't there. They're not personally implementing this concept of becoming your own banker, the process that Rob's, they're not personally implementing that in their lives. But if they can use some language that will help them in their business, and I'm not bashing the business, but I'm saying be wary. If they're not personally implementing that process, but are able to sell you the product, I mean, that just is what it is. That's not what, somebody who's looking to become their own banker is looking to do. They want to be working with somebody who actually implements the process and helps people professionally implement the process first. That's been what I found to be true. People want to know that I'm doing what it is that I'm educating on, and then they want to know that I can help them in a very customized way that suits them. So there's that generic insurance way of policy design, and it could be an all-based policy. I think you were talking about that earlier, Rob. If you could have an all-based policy, it has its advantages over any other type of policy. I don't mind talking about that, but I'm trying to say, here's some bigger filters. Let's get narrowed down in on some other things. When you get into the infinite banking space, you might see anything from professionals having a cookie cutter approach where they say, oh no, the policy design is going to be this. Before they know you, before they know your cash flows, they're going to say, oh, I do and then insert whatever you want. I do a 50-50. I do a 40-60. I do a 10-90. Now, here, David, maybe you would jump in and just, these are common things that we would hear, but let's say somebody's hearing me throw these numbers out for the first time. 10-90, 50-50, 40-60. What would you tell the general public when it comes to splits? Which I'll go ahead and say that just a policy split is not policy design. It's just one aspect of what could be part of your policy design conversation. But what does that even mean? 10-90, 40-60. What's that referring to, please?
So typically when you hear about these percentages, it's alluding to the percentage of your premiums that are being attributed to the base part of the policy, which at the end of the day is the base guaranteed death benefit that is that a dollar is a premium going towards. So a 1090 would be 90% of your dollar is going toward to pay for the base part of the policy that's going to purchase X amount of death benefit. And then below that, the percentage, again, that can vary, is around the flexible part, I would call it, of the policy design, which I assume we're going to get into, that purchases typically a variable type of death benefit that could be permanent, but it's usually, at least my designs are usually alluding to the temporary term portion of their premium dollar. So 90/10 would be for every dollar, 90 cents, for instance, in a 90/10, 90 cents would be going to the permanent part of the policy, and 10% would be going towards this flexible, could be a term. I use the word rider because there's all different ways of, a lot of different carriers have different ways that they, the vernacular that they use in their design. But basically the design, the percentages that Jesse you're alluding to is basically how much is going towards the base part of the policy, which is the death benefit, and then below that is a variable part, which again we will, I guess, get into the weeds of design and why one design may be better than another, and you'll maybe hear about this is a skinny policy versus a fat policy. What Rob talked about with like an all base policy would, in my mind, be called a fat policy, which is it's there loaded and bear with as much base part of your premium going into the policy, which will have short-term and longer-term implications on policy design.
You covered a lot of ground there, and I appreciate it. I even realize now, though, that I asked that question poorly in a way, just because when it comes to policy splits, people even refer to those numbers in different ways. So when I refer to a 1090 or a 4060 or a whatever, I lean into saying, well, everything's built on the base policy. So the base percentage of the total premium is described in the first number. And then everything that would go into the paid up additions rider would be the second portion. So a 1090 would be 10% going to the base, 90% going to the PUA. A 4060 would be 40% of total premium going towards the base premium, and 60. But there are professionals in the space that say it the other way around. So I even realized that I asked that poorly. Beautiful. So policy split, and then even there we could get some nuance when it comes down to it, right? It's like, okay, well, if I have riders, if I have a child benefit rider, if I have a guaranteed insurability rider, if I have these other riders, which one of those two numbers represents, my monthly or my annual contribution towards those riders that I had designed on my policy for the features that it provides, and that can be deduced from the base premium. So, all right, policy splits, but that's a big thing out in the space. Always has been. Folks feel strongly both ways. There's so much more that goes into policy design than just policy splits, though. What else sticks out to y'all? Either they're on policy splits, because some people, again, they're just firm on, well, I do max funded, overfunded, efficient. They'll use whatever language they're going to use, and they're just simply saying, not everybody, but I'm saying this is a generality. If somebody says language like that, they're trying to simply describe making the base premium as skinny, to use your word, David, as small as possible, to be able to have as big of a paid up additions rider percentage of your total premium going there. And, you can even see it down to 3% of someone's premium going towards the base and 97% going towards the PUA. So what are some things that y'all would say further about policy splits, or why an argument could be made for one or the other, or something in between? I'm just trying to leave it open.
Well, I would say it's important to ask the questions. So if somebody's talking to you about a particular policy split or something along those lines. Why do you do that? How does that benefit me today? How does it benefit me 10 years from now? And how does it benefit me when I'm ready to, pass on? What are those advantages? A lot of times you'll hear efficiency brought up, right? Well, by design, the base premium is designed to get significantly more efficient over time. So that efficiency is going to happen. That's how these contracts work. For anybody who's not familiar with whole life contracts, the the death benefit and the cash value will equal one another at age 121. That is how they are designed to work. So at least in the United States. In Canada, it's a little bit differently, but in the United States, it's age 121. So if that's the case, they're naturally going to get more efficient by design that way. So what I think we have to ask the question of what is efficient, when you're if that's a good question to pose to your agent. What does efficient mean to you? Because efficient upfront could actually be significantly hampering your efficiency later on if you're not properly structuring things out in a way to account for short, medium, long-term type efficiency. So those are there. And again, the point of it isn't to get really nitty gritty in details. It's let's make sure that we understand the basics of what some of these things do, and then we can understand what's the right structure we should implement in a given product. So, or at least a given product to achieve a specific process. So some customers, some clients might want something that is a little bit more efficient upfront, or depending upon their needs. Some clients may need something that is a little bit more efficient towards the back end. There's all different takes there, but I think ultimately it's asking good questions to make sure that if somebody's telling me maybe a policy split, what am I what does that mean? And what does that mean to me, the client, and what does it mean to you as the agent, and vice versa? So a lot of different things or ways that we could take that, I guess, but uh, really just asking questions, I think, is really important throughout that process of somebody's, getting into hearing some of these things maybe for the first time or working with somebody directly.
Mhm. Yeah. It's always good to ask why, in my opinion. Why? Can I say something? Go ahead, David. You go ahead.
This is your show, but
Please.
so I was just going to add to what Rob said is that, of course, everything is going to be specific to the individual or the family or the business owner that we're in front of to ask good questions
Mm-hmm.
about, what is the problem that you'd like me to help solve? So there could be a myriad of answers that we typically get. It could be legacy, it could be cash flow. It could be somewhat shorter term in the client's mind or prospect's mind. And all of these will be, of course, at the end of the day, the determinant of how a policy will get designed. What I would say is that to get a little specific, there are definitely ways to um, de define what efficient is, right? So, like, I'm sure Jesse, Rob, you guys probably talk about concepts like cash on cash or capitalization period, meaning, when you're looking at design, it could be important for someone to see when they're putting a dollar of premium into their system, what is that dollar growing in equity on the cash value side. So, um, like Rob said, just it's questions that you ask, but I'll also say that, what's important to know is that at the end of the day, that it is a life insurance contract, and most of the benefits that I see that you derive, i.e., dividends and such, are going to be mostly determined by how large the base of the policy is at the end of the day. But we have to make sure that we marry that concept with what's important to the client in terms of how much they want to pay for the cost of their system. So there's all these nuances that, we can get involved in discussing, but that's what I see in, what's the best design. And I mean, there's so many different answers. Again, it goes back to what the person you're sitting in front of, what answers they're giving you about what's important to them and what problems that we're solving.
Right. So I want to dig deeper in that area that you brought up, actually, David. But I'd also put in a word here to the consumer that to keep this in mind. You don't have access to some special software from an insurance company that you could be contracted with that I don't if I'm contracted with that insurance company. Meaning, here's what I'm meaning by that. You or I or Rob or anybody else can, in a way, make a policy illustration dance, right? Depending on what we want it to look like for you, whether our intent is just to make something palatable so that you'll say yes, and that there's a sale and there's a purchase and there's premium paid and then therefore commissions paid, right? Like you or me or anybody can make an illustration dance, make it look X, Y, or Z way. I do caution people. I want to say a few things here. The illustration is just that. It is an illustration. I'm a big believer that illustrations can be helpful. I'm also a big believer that illustrations can be hurtful. So I'm more of a visual guy. I like seeing visuals. It's helpful to me. And you're right, David. People like knowing some things now. They can take this to the extreme, I would say. It can be taken to the extreme to where you're looking at a policy with an investment eye when it's not that categorically. It is an asset. And what type of an asset is? It is a contractual piece of private property that you own between you and the company, unilateral, okay? So it's a private piece of property, it's a contract, it's an asset, but it's not an investment. So it's these things, but it's not that. And if we try to use an investment eye to ask the questions of, well, okay, when do I go dollar on dollar for the cumulative premium that I've paid? I don't think that's a bad question. I don't think it's a bad one to answer, but I am saying that it could take you off of looking at the process of becoming your own banker. So it just depends on the attitude of where that question is coming from. Do I also think that it's bad to look at, okay, well, how many years have to go by before I get to that first year to where in that year, the dollars that I've paid in premium are reflected in cash value dollars that I can leverage? I don't think that's a bad question. I think that's a great one to answer. But again, could it be taken to the extreme? Yes, it could. So I think that those are helpful questions, but I'm trying to encourage people to remember that illustrations are just that. They are an illustration that's been very narrowed in to made to show a certain thing. Yes, it's going to have guaranteed features and whatnot, but even those change depending on your policy design. So just a word of caution when it comes to policy illustrations. I speak more on it. I've got an episode on my encyclopedia series where I talk about policy illustrations. If you've not seen it, I would encourage you to check that out. Can I make some descriptions of what policies might look like? Y'all inspired me earlier to say something about, say, Rob, when you mentioned all base. I can see instances where an all-base policy is the best solution for somebody. I've had this happen. Somebody applies for an IBC style policy, right? And then for whatever reason, maybe because of a health rating, they're approved for a policy from a company, but they're not able to get a paid up additions rider. Now, depending on their whole financial footprint and their plans and their priorities and their cash flows and their assets and everything else, that could be a great move for them to acquire actual permanent. And I'm intentionally using a word right there that, again, is part of that jargon that David was bringing up earlier that we might need to touch on some more. That could be a great asset for them to own for so many reasons. And that's an all-base policy. Now, on the other end, if somebody had a 30/70 design, that's much more liquid in its earlier years, okay, than an all base. It's going to take years and years to do anything, right? So there's that. Could that be a viable solution for somebody who really does need access to significant liquidity in their earlier years of utilizing a policy for becoming non-banker? Yes, absolutely. And then does that mean that there are some things in between that could make sense. Yes, actually, there are instances where someone might even want a MEC. They might want a modified endowment contract, which again, thanks for bringing up, David, we got to be putting some plain language out there. A modified endowment contract is simply a policy. It's still an insurance contract, still an insurance policy, but it loses some of its tax advantages. But there are also reasons why someone would intentionally do that. You brought up the concept of legacy earlier, David. There are some legacy reasons why somebody might want to own a MEC, actually. So I'm just trying to put out an array of policy designs at a high level anyway, and say that, well, depending on the person, all of those could make sense, or variations of them could make sense. Anything there?
I'll say that I think there's a lot of misconceptions about, at least if somebody's interested in infinite banking, or they are interested in, or perhaps have heard about whole life, so often, I mean, you obviously have the Dave Ramseys, the Susie Orman, stuff like that, talking about how whole life is this terrible thing. In reality, though, it's a misconception of understanding what it is and how it operates. And I think for the average person, understanding that there is a distinct difference between a stock company's whole life contract and a dividend paying whole life insurance company's contract. There is a significant difference, and they do not operate the same way. And I mean, I was just looking at one very recently where it was a full base policy where by year 6, it was returning in cash value the same amount as the premium. And this was a pay to 95 contract, right? So this is not designed to run for a very short amount of time or anything like that. And then by year 16, the dividend was equal to or exceeding the premium. And you still had another, at least the premium or a multiple of the premium plus in guaranteed cash value growth by year 16. So, I mean, these things can operate extremely well. And for somebody to look at a contract like that and say it's a bad thing is somebody not looking at the whole picture. It's taking a generality and applying it to everything. And that would be like someone saying, well, my only experience with an automobile was a 7-year-old Kia, and that means all automobiles must operate the same way. And that's how they all work. Like that just doesn't make any sense. And you can't apply that same methodology to a whole life insurance contract. You can't apply that to really anything in the market space, because there are variances. There are differences in companies. There's differences in how things are put together, how the companies are run. I mean, we see that in virtually any industry. So the life insurance industry is not exempt from that either. So I would just challenge people to say, like, really understand how this stuff operates so that you can determine, oh, maybe if my policy didn't fit this preconceived idea of what, quote unquote, an infinite banking policy is supposed to do, or the characteristics are, maybe for my design, my agent is doing that for a very specific reason. So again, there's a lot of different things that we could get into there, but certainly it's one of those areas where I think there's just a lot of misconceptions, and people have a misunderstanding of how some of these things actually work in reality. And then they kind of jump to a conclusion based off of that misconception. So, and I think that's a lot of what we're trying to do here is let's level that playing field. Let's straighten things out a little bit by talking about some of these things. At the end of the day, premium is premium, and premium is generating both current and future capital for your system. So if you want to be able to continue to capitalize for a very long time, there's a certain way that we have to put some of that stuff together to be able to do that. And I would think that most people, if you begin to understand the concept of infinite banking in this process, you want to be able to flow as much of your income into that system as possible so that you have the ability to utilize that system and do what you need to for as long as possible. And if we don't think about that and we don't understand the mechanics that make that or allow that to happen, we could actually shortchange ourselves in the process. So just something to kind of think about on that front, I guess.
Well, hold on. Are you trying to say that a 7-year-old Kia is different than a 1970 428 Ford Mustang Cobra?
Just a little bit.
Right, right. Okay. I love it. I'll tell you what, you made me think about, yeah, even though I've said what I've said about my most recent policies are more optimally designed, knowing what I know right now. The dollars that I enjoy paying most, though, if I had to pick, is in my oldest policy, even though I wish it had some features that it doesn't, because it's the most efficient. No, and I mean efficient in the realest sense. Okay, in the realest sense, not in a design sense, but because it's just the oldest and I've used it the most. I've done a greater volume of infinite banking with that policy because it's the oldest one. So I've had it for the longest to be able to use as a privatized banking entity, right? But furthermore, it in of itself, just as a plain Jane policy, is with a great company, is a nice long dated whole life policy, did have and still has a long ramp for me to pay paid up additional. So no frills, no bells, no whistles, no features that I do wish that it had. But even with that, it's the more efficient of my it's the most efficient of my policies because it's the oldest. You've inspired me, Rob. What if we took this conversation through some iterations of filters where we just keep getting smaller? And I want you to go where you want to go, but let's start from the top by saying for folks that want to implement infinite banking, Nelson says that that's optimally going to be done with mutual life insurance companies. So you brought up, stock company versus mutual company. And while life insurance is life insurance and the contract says what the contract says, oh, here, let me say this at this point. Also, kind of touching on the policy illustration point that I tried to make earlier, that's not the contract. Everybody should be familiar with your actual contract. Know what you have, and like Rob said also earlier, why you have it. Why you have it. And then if you're going to consider getting another life insurance contract, what do you want it to look like? And then what does it actually say? Not just what does the illustration show you, all right, what's it dancing to show you, but what does the policy contract look like? How does it operate? But Nelson did say mutual's better than stock. He said participating, meaning that mutual life insurance company has a great and a long track record. For me, the barrier is 100 years, 100 plus years of consecutive dividends. Okay, would be another filter that I would add. And then I just want to be able to go as small as y'all want. Something else, I guess, that at the top sticks out to me is, well, there are a lot of big companies out there that don't embrace the idea, the philosophy, the agents, and the consumers that implement the infinite banking concept. So for me, that's both as a consumer myself, I'm a purchaser of whole life insurance. I buy these policies. I have 8 policies. It matters to me personally and it matters to me professionally. And there are companies that embrace the infinite banking concept who knew Nelson, met Nelson, etc. What other filters would y'all maybe walk through? I mean, I know that there are several. What kind of life insurance? Well, Nelson also did say whole life insurance at the top. So if we could just automatically put out the universal policies, the buy term and invest, the difference. If we do get honed in on whole life insurance, but I'm not trying to just cut y'all off. Y'all jump in at any of these levels that you want and begin to add them, right? But then types of products and then what riders do you want and the policy splits and on and on and on. What do y'all think about that?
Yeah,
Well,
go ahead, David.
at their core, most companies that we as practitioners use, again, we abide by the idea that you are building a banking system. And what you're doing is you are actually, you optimally want to be exposed and have a system with a counterparty, meaning a carrier. One, Jesse, as you alluded to, I would obviously I prefer to have a long-standing history of uninterrupted dividends, i.e., the divisible surplus that the company is earning, so they are profitable and giving, because you're going into business, not even essentially with these companies, because there's a contract. At the end of the day, these are contracts. Like you said, you can make an illustration. I love how you said that, make it dance, because that's exactly what happens, is that you bring it to life in whatever way you feel that you are going to position it and make it look the best and most attractive to the person that's digesting the illustration, correct? But to me, the devil's always in the details. When a policy gets delivered, I always like to make sure that I don't look at every minute detail, but I like to see all of the schedules of what the policy in terms of the design is going to be. Let's say when we talked about percentages, I don't want to get too technical here, but if you have, let's say, a policy where there's a combination of a base whole life policy, and then you have quote term riders and whatever. And again, there's all these different carriers that they all have different acronyms. There's an EBIR at one carrier, and then another carrier will call it, a SITR. There's all these different acronyms. At the end of the day, I think, Jesse, what you're alluding to is just know what you're purchasing when you are presented with, a concept that starts with an illustration. But getting back to the point, my bare minimum is that, like you said, at least 100, hopefully over 100 years of uninterrupted dividends. Because to me, I come from Wall Street, so I like to tell people that this system and what I am proposing to you has lasted through a lot of different, I would call it economic turbulent times over the course of 100 to 120 years. So if I'm going into business with a company that has been able to uninterruptedly be profitable no matter what the environment is, to me that's a company you want to have and put your stake in the ground with. Meaning they went through the depression, or they went through, all these different times when, let's say, the banking institutions, if we can go there for a minute, needed to be bailed out because of their inefficient ways and non-profitable ways of running their companies. As practitioners, and I know that's why Nelson talked about it, you're going into business with these companies and you want to know that they know how to run their own books behind the scenes, because they need to stand up to the guarantees that they are putting in front of you, that they are going to, pay at some point, whether it be in the short term, intermediate term, or when we all graduate this earth. So to me, those are criteria. To me, I don't look at dividend yields, and again, because this is not about rates of return, but we're just talking about steadiness of a company. I think that's, Jesse, what you were alluding to.
Yeah, I think that's a beautiful and a strong point to bring up, the historical ups and downs, that these insurance companies have not only weathered, but been profitable through. I mean, when you don't just weather the storms of, World War I and World War II and the Spanish influenza and the housing crisis and dot-com, Y2K, all this, and you're profitable, beautiful, beautiful. I don't get bogged down in the numbers either. This company, this dividend, that company, that dividend, because companies can make their dividends also dance, much like an insurance agent could make a policy illustration dance. Like there's something to understand beneath that. I actually don't mind, David, so I'll go ahead and do it too. Get detailed. Like when you brought up EBIR, an enhanced blended insurance rider, versus a standalone term insurance. I don't mind talking about that kind of stuff. I actually think that, and you that's listening, you let us know. All right. This is a place where you could down in the comment section say, Jesse, we're on board with this, or we're not on board with this, meaning these higher level things that I've brought up. Like, do you disagree with us that we should be preferring mutual life insurance companies that pay dividends, that embrace the infinite banking concept and stuff like that? Because if you don't have anything to say back to that, it doesn't seem like we do. We'll get into those more nuanced details. I love it. So I actually have a preference. I'll just go ahead and state it on that, to where if, and that's a big if for me, so I'm just not automatically slapping term insurance riders onto a whole life insurance policy. I actually prefer for them not to. If there's a need for term insurance with me, typically it's going to be a convertible term insurance. That way the client has the option in the future to convert it to a whole life policy that can be designed for their wishes at that time. So it's my default not to want a term insurance rider if possible. Now, that's not to say that I won't do it or that it's not appropriate. It can be for sure, but I like to have those separate typically if I can. We're going to have an IBC style policy that's going to be used for the banking function in someone's life. And if they're building out more of a footprint for themselves for future branches of their banking system, that could be a convertible. So with that being said, so EBIR, at least with some companies, the percentage, or rather the premium that's being paid to acquire that term insurance can use those beautiful dividends that you were just talking about. I don't want my dividends doing that. I want my dividends from year one to begin that uninterrupted compounding process. I don't want my dividends going to help offset the cost of term insurance. Now, again, here's where I'm not saying that's an absolute. Have I had clients that due to a health rating, it seemed to be the best fit for them, that we couldn't get a standalone pure paid up additions rider on them without the enhanced blended, okay? And was that the best option for them? Yes, there have been cases where that's true, but my default is I don't want term insurance on it at all. If I am going to have term insurance on the policy, I would rather it be something standalone and separate and not something that consumes those earlier dividends and then just tapers off. I hope I described that well, but again, if y'all disagree or have some different perspective, I'm excited to hear it.
I had a question about what you were just, are you saying that you, in sometime in your design, you will create two separate policies, so you won't necessarily blend them in the one policy? And then
Great.
you'll have them you'll have them act independently from each other, but with similar effects, so to speak?
Yes, sir. Great question. So two numbers I introduce people to, David, in my process is number one, they're coming to me for infinite banking. So I like someone to know when they pick their premium amount. Okay, so this is actually one part of policy design. Is like, well, how much are you wanting to be capitalizing into a policy, right? So that's a feature that you're picking. I don't pick people's numbers. So when they determine what their premium at least range is, sometimes we'll start out with a premium range in our discussions as we're strategizing and going back and forth. But when they are decided on a premium, I like showing them, the first number I like showing them is, well, that represents this percentage of your gross cash flow. All right, so we all experience cash flow and income every year. So I like making people familiar with, well, okay, if we're going to make this exodus from the conventional banking system, we're going to do it step at a time. You don't do that overnight. Nelson talks about it being a process in his own life. It's definitely been a process in my own life. But I want people to realize that, okay, well, I'm considering 10% or whatever the number is of my gross cash flow being dedicated towards this first policy that I'm going to begin banking with. That's one number. It represents a certain percentage of their annual gross cash flow. The second number I like to introduce people to, David, is how much insurance is even available to them. All right, so everybody's only eligible for however much they're eligible for based on their net worth and their income and their age and these factors, okay, that I just want to make them aware of. So yes, it's very typical in my process anyway for someone to acquire a whole life insurance policy designed for infinite banking, but then also they'll be applying for a second policy that will be a convertible term policy that's going to help them acquire more of that human life value, more of that available insurance. And again, that's a number they determine. They might want everything that the insurance company would give them. They might have a certain number in their mind from their cash flow that they know they could dedicate towards acquiring whatever amount of what's available to them. But I like throwing it to a percentage. I like somebody to know, okay, hey, by starting this infinite banking concept, I'm beginning to put 10% of my cash flow towards this privatized banking system. And I've acquired 50% of what's available to me. Yay. It's like a double whammy win for me. Did I explain that well? Do you got a follow-up question on that? Did I answer your question?
No, I'm good.
Yeah, Jesse, I think you bring up a phenomenal point, and I'll state this. There's one point I want to make first in that what we were talking about earlier, we were talking about companies and how long they've been around, all that stuff. I almost think that could be its own show because, like what are some of the criteria we would use to determine if a company is worth, utilizing for the infinite banking concept? So I don't want to go down that path just because there are a lot of different
But you
things,
introduced it
but
though, Rob. So give us a couple. Give the people a couple of things at least.
No. I mean, obviously there's, dividend paying whole life insurance company, participating company. They've been around for at least 100 years, like what you guys said, and dividends in every one of those years. I personally prefer a non-direct recognition company, just because if I'm the consumer and I'm the one using it, a non-direct recognition company benefits me more than one that would be a direct recognition company. And we can get into that separately if we want to, but that is an area that's worth talking about. Again, why I said we probably want to go a different route with that one, but separately, is the company IBC friendly? Like, as a consumer, and I'm going to use this product for the process of infinite banking, does this company treat it well? Meaning, if I want to take a loan, is that process simple? If I want to make repayments and make them as frequently as I want to, is that easy? And that's a big part of it. So those are kind of some of the basics, I guess, that you would have there, when I think about company selection. But the last thing that you had said about overall eligibility really comes into this conversation. As much as we would think we can just get as much as insurance as we want, we can't. It is not a right. It is more of a privilege. And that's based off of a lot of different factors that the underwriting departments help us determine. And in that process, the policy design does become really important, because some of these policy designs that are out there use up a significant portion of someone's insurability if they are designed for quote unquote max efficiency, or some of these terms that get tossed out there, and they'll eat up a lot of that insurability. And then later on, as your knowledge, your understanding, reading it, becoming your own banker multiple times, you're like, oh wait, I think I might have maybe gone down the wrong path. Well, you might have eaten up 90% of your insurability on a really small type contract that doesn't suit your actual needs. So that's where we have to be cautious about some of this going in. And that's one of the reasons why I really, as you and I have talked before, your process about structuring convertible term so that somebody has that capability to convert and use that towards their system. Like, those are really positive ways that building a system, or I should say thinking long range, comes into play when you're structuring the contracts and talking about the design overall. So yeah, that was just one thing, as you guys were kind of talking around some of these riders that can go on there. It's like, we got to be careful in how we do that. And I much follow a similar process to you, where I'm looking at, well, what if we didn't use any at all, any term at all? What does it look like, and how do we structure that? And does it achieve what the client's needs are? If it does, then maybe we go that direction. And then if it doesn't, well, how much of that insurability do we want to consider using for that and does it allow us to achieve the goals that we're looking for?
See, again, I'm appreciative to you bringing up something specific, just like David did earlier. I love that you brought up about non-direct versus direct, and I own policies of both types, meaning, and I've banked with these policies for right at a decade for the first two policies that I can think of. So my first policy was actually direct recognition. I did not know that at the time. I didn't know what direct recognition meant. I didn't know that that's what kind of policy mine was. And again, in a way, did it stop me from banking with that policy and beginning to pay off my student loans and credit cards and our family car? Nope. Still did all that. Have we financed family vacations with that direct recognition policy? Yep, we sure have. Have we done business activity because of having access from, that contract, owning that contract? Yes. But also, I have this track record of, I've been able to see the differences between those two types of contracts and their treatment when it comes to dividends. And I've been able to see between my first policy that I got and the second policy that I got how the death benefits have grown and what those differences are. And I can tell you, it's a multiple six-figure difference on the death benefit. That's a big difference. It's not nothing is where my stance is, right? Because I own these two contracts and that's what I see. That's what I've experienced, okay? Multiple six-figure difference between the death benefits, but they started the same. And I've used them very, very, very similarly, meaning so similar that I don't know the difference between how I've used them over the years, okay? And then therefore, of course, has there been a difference in cash value and has there been a difference in the dividend treatment that I've received as owner on both those? Yes, there has been a difference. So I'm glad you brought it up, Rob. That is my preference. But again, have I been able to do a lot of banking with that company? Yes. Are a lot of, great companies, direct recognition companies? Yes. Now here's something that I don't mind picking a fight with, where and you see and you'll hear this, and some people are going to have this. This is where some people are going to be, and this is why I like having these discussions and letting y'all bring up these points that y'all are bringing up, fellas, is because someone will hear about infinite banking, they'll get a policy, it will be quote unquote efficiently built, like you were describing earlier, right? So 90 or more percent, let's say, going towards the paid up additions rider, insignificant or a fragile amount of base premium is dedicated in that contract, but it does build up a significant liquidity in year one. But then, especially if it's with a direct recognition company, there are people out there, there are agents out there, folks who hold a license who will say, well, yeah, we've built up that there with that direct recognition company. So how about you go to this bank or this, financing, company that we have a relationship with, and leverage your policy to go get bank money for the things that you want to do. And I don't mind picking a fight with that. It's maybe
I'll
more
take
than
that
the
fight all
opposite.
day long.
Right, right, right. It's like, no, don't do business with banks. Number one. But even I know people that very intentionally are implementing infinite banking. They still might use banks for some things, whether it's financing a car, whether it's, their home mortgage, they haven't paid off their home mortgage. Like, I'm not going to fight a battle there, but I certainly don't want to be leveraging my most valuable assets in life with commercial banks. Not about it. And definitely not encouraging clients to do that either. Not saying people can't
Are
do what they
you
want, but that's not the banner I'm under.
right? Are you by any chance referring to a strategy by which you use you talk about a let's say a PUA heavy policy to then go back to the bank to use as collateral to be able to then go back to the bank and then have the bank give you money that now they're gonna charge you interest on, and now you're basically undoing the tenets of becoming your own banker, because now you're now abdicating the banking function again by taking your policy and your system and then going back and running back to the
Mm-mm.
institutions that you were looking to try to avoid business with. Is that what you were?
That is what I have seen and heard and am willing to fight against. Yes, sir.
Yeah. Because there's a lot of people that I've been in business with over time that will talk about getting lines of credit and having banks extend capital from the actual policy that's been designed, which it sounds attractive because at the end of the day, we all are looking for capital in one way or another, but um, that's not the way to go about getting additional capital, in my opinion, because what you're I mean, I have had clients, by the way, that have done this where, you're assigning, I don't know if I get too technical here, Jesse, but assigning the policy to an institution. Now that institution's now setting the terms of how that policy is going to be paid, paid back. You're now again, you're giving control up again. So I think that's the fight you guys may be alluding to.
Yes, it's the antithesis of becoming your own banker, assigning your private property to someone else. Um, yeah,
It,
Yeah.
I
that,
mean,
that is what I'm describing.
it's like taking and saying, "Oh, well, I have my home. It's mine. I own it, and because I want access to some capital, I'm just going to assign it to the bank and give them full access to my home." It's no different that way. But that's what everybody's been taught. That's what everybody does today. So like that feels natural to a lot of people,
Mhm.
but it really is the exact opposite of what we're intending to do with becoming your own banker, that whole process of taking that function and bringing it back inside our system so that we don't have other people involved in our financing. And again, sometimes we have to use it, but that's the point of becoming your own banker. Is you're the one who is in a position to be able to call the shots. You can decide if you want to allow a third party into your system. There's a difference between having to have that happen or deciding if you want that to happen. And that's a big one. And I love that I've been able to learn this. I love that I've been able to help clients come to this realization as well, because when you get to make those decisions, it changes everything because you're now the one who's in control. You're in control of how things are going to move, flow, um, how money's going to flow first, who gets it when, etc. Like that's really important to have in peace of mind in any financial situation you have. So yeah, I definitely agree with what you guys are saying there.
And here's where we could say, it's a beautiful thing, actually, though, to realize the ability of that type of an asset is that a bank would be willing to let you bring that to their table. It's that kind of which just makes me want to go back to, well, let's look at this again from a high perspective. Banks buy whole life insurance. They do consider it a tier one asset in their own portfolio, let alone what we might would bring to them, coming to ask permission to, use their services by relinquishing, rights that we have to this private property to leverage it and go out and do X, Y, or Z. So it's a good thing to keep in mind. Well, I'll tell you one thing that I for sure want to do. I don't mind telling folks some things from my own practice that I implement with clients and we've not exhausted these things. I still feel like we're doing a good job. I feel like of getting down, y'all bringing up EBIR and direct versus non-direct recognition, but there's more to it than that, right? Like there are things that we haven't touched on yet, like, well, even if you get honed all the way into whole life insurance, great companies, all the things that we have covered so far, or all the things that we have tossed out that aren't for us, right? Like, oh my goodness, variable universal life or anything else. Well, these companies can offer whole life 121, whole life 95, whole life paid up at 65, whole life paid up. So even there, you might have 3, 4, or more options of what I think is very important, which is the runway of how long you can be capitalizing in a particular given entity. Let me say this while I think about it. I think you should approach getting a policy as if it were going to be your last. So having said everything that I have about, I think everyone should be customized to you, but have that mindset of if this were the last one, am I getting everything that I want with this entity? I think that's really good to keep in mind. But it's getting you a runway, or if you're going to actually treat it like a bank. Well, if I'm here and I'm 120 years old, I promise you I'm going to be using money. So to be able to have a runway still of somewhere to capitalize and somewhere to deploy capital from, because but I want the contractual right to be able to pay as much capital, premium. Let me be exact also, as much premium as possible for as long as possible. So that means that the base policy matters, the selection matters. Now, again, are there variables though that would determine whether somebody at a given age would want to pay it up at 65 versus a 121? Yes. So let me just pause right there, because that's maybe one mid-range filter or a smaller filter, I think, towards getting an IBC style policies. Well, what would y'all say about the different contracts there, taking, paid up at 65 or something like 121 as examples? Why might
Yeah,
somebody pick one over the other?
I again, I think it comes down to what are the needs of the individual and where's their understanding at that particular point in time. But I think back on this particular topic to a conversation we were having with our good colleague Joe at the think tank, and we were talking about contracts, and we were talking about how each individual contract, even from the same company, operates a little bit differently. And it is based off of how is that contract structured? Does it pay to, is it a pay to 95? Is it a pay to 75, pay to 65, or whatever it might be, right? Those things matter in terms of how much premium do I want to be able to pay and for how long. And I think if, one of the things that sprung to my mind as you were saying that, Jesse, is yeah, initially maybe because my mindset says I wanted to pay to 65 product because I wanted to be quote unquote done. What's to say that you didn't properly or you didn't use that policy in a way that now it's generating significant amounts of income as you approach retirement age? Now you need a place to put that money. You still need a warehouse for your wealth. So you might have a ton of different investments that you've made that are now returning a lot of income, and you need a place to put it. Well, if I didn't take my time and also think about, well, maybe I should have also had a pay to 95 product or to go along with it so that I can still continue to capitalize that system and build that system with that income that's now being generated from my assets. I could be in a tough spot where I have all this income and I have no place to put it. And it's just going to either flow away from me, or I'm forced to leave it someplace where maybe it isn't treated as well as what it is within some of these whole life contracts. So just it really bears to mind of when I'm making that selection, am I thinking long range? Am I afraid to capitalize? Do I want to do business with banks? These are all of Nelson's principles, right? We have to be thinking about these things before we make those selections. That helps inform our decision. Now, is it a scenario where somebody might have 2 or 3 different types of contracts for an explicit purpose? Sure. Some people do that. But to your point, I really like the idea of approaching each one as if it's going to be your last, because that's really good from a scenario of what if my insurability goes away? And if I take the right steps with that contract, I can actually help ensure that I can add more to my system over time, even though my insurability may have changed because of the different riders, the different things that we can do with, the long dated term and different stuff like that on the contract.
Well, I love that you brought us back to remembering to think long range. I would also say too, though, Rob, that depending on the type of base contract that you're selecting, that's what can determine how much of a warehouse you can have later on. Meaning, could you pay PUA premiums longer on a 121 product than that paid up at 65, which, the paid up at 65, again, just in case we're meeting the brand new person, that means your base premiums also stop. That means so no premiums whatsoever stop at 65. But if you got a 121 product, it's the case that you could even be able to pay base premiums, obviously, and also paid up addition premiums beyond the age of 65 because it's a longer dated contract.
Right. So what I in that sense would typically like to design is to give the prospect, because life will have its ebbs and flows,
Mm-hmm.
is to give the client the flexibility and give them options in the future. So as you talk about, you know, paid up to 95 or paid up to 100 or 121, there of course are going to be ways where that could be pared back or enhanced, but I would prefer to have a longer initial runway that I could shorten a runway with different mechanisms that can be changed internally in the policy design over time. Riders can be dropped, and such. So, and as you guys all said, and we in the insurance industry, even though this is not just about life insurance, but we'll just talk about it, is that the best day typically to get life insurance was yesterday. So if we could lock somebody's insurability, because we know what their health is today, we don't know what it's going to look like in the future. So why not like have that in place and just lock that in, and we could build around in the longer term, whether it be, you know, give the client the option of adding or taking away. But just, I don't know if that answers, like, so that would be my suggestion. That's how I design policies. Give the client options, give the prospect options, because life is again going to be a flowing river. There's going to be times when you're going to be flush with some extra money, whether it be a windfall or whether it be, you're in your business and you're cooking with gas and your revenues are increasing and you have more ability, you have more premium tolerance a little bit like 5 years from now. Have that flexibility in the design, whether it be 65 or 95 or 121.
I love that you brought that up, David. Our treatment with our knowledge, our treatment of a 121 policy can make it like a paid up at 95, paid up at 65, or even a 10 pay. Could I treat a 121 policy as a paid up at 10? Yes, I could. I could be paying as much paid up additional premium as the insurance company can let me for a diligent 10 years intentionally. And I might do that anyway on a 121 policy. But I'm saying if I artificially wanted to make a 121 more like a paid up at 10, I'm in the driver's seat and I can do that. And if I capitalize for 10 years and want to stop, can I do that? Yes, I can. But if we start out with a 10 pay, can we treat it like a 121? No, those same options are not on the table. And again, I'll say right there that right there goes back to if you're a brand new person and you're vetting this concept, illustrations over here could dance. These quote unquote efficient illustrations can dance, but part of my wanting to host this particular discussion is to empower the consumer to know that I'm not telling you what to do, but if we can get you as many options like David is describing right there as possible, that means you get to select how you're going to even treat that policy. But we definitely want to optimally design it for you and with as much variability and flexibility as possible, but while still building it robustly and still adhering to these principles that Rob's reminding us of we're going to need a warehouse later in life. We do need to prepare for windfalls. We are going to want to be able to capitalize in the future as well because of our utility of money and everything else, thinking long range. So, you and your knowledge, and of course anybody that's listening to this, they're getting into the weeds with us, right? In talking about EBIR and non-direct and all this stuff. But that's the point, is so that you can know these things when it comes to the design of a policy, but also, and maybe more importantly, the use of a policy. Because even a suboptimally designed whole life policy from a great company that does pay dividends can allow you to operate in so much more of an advantageous environment than conventional finance, where we're reliant upon the banks and they're just bleeding out money dollars from us for the things that we finance. I hope I said that well. I think it was a great thing that you brought up there, David. Anything
Yeah,
else that you go, Rob?
yeah, I was just gonna say, so design, all of that stuff is important, right? Like we have to consider all these different avenues, different ways in which you can adjust the policy, structure it, etc. At the end of the day, once you have that product, it still comes down to how you use it.
Mm-hmm.
So, and Nelson said this in the book, and obviously, Bruce says this often as well. When the product is there, so little of it is dependent upon the company at that point. It all comes down to your activity. How do you put it into practice? How do you utilize that product? How do you pay the premiums, etc.? And if you are going to maximize it, you're going to use it to its maximum ability, then it's going to do what you hope it does. But if you get this quote unquote perfectly structured contract, which I'll put that in quotes because it doesn't really exist. But I mean, if you had that, but you choose not to use it in that manner, well, then you just changed exactly how it's going to work. So it really comes down to the person and how they actually use the contract. How do they pay the premium? And do they implement the process of infinite banking? If they don't do those things, then it isn't going to do what you think it's going to do. And it really just comes down to our own behavior.
Right, which Nelson highlights very clearly in the book, is that the human element, that's always a variable that's very hard to quantify and to keep in check. Because a best laid plan can go awry very, very easily.
Mm-hmm. Yeah, at the end of the day, too, the policy that matters is the one that's actually in force, right? I mean, when you know enough about this concept to know that you're going to implement it, does policy design matter? Yes, that's why I'm willing to have a 2 hour long discussion on it, right? But if you don't apply that knowledge, what's the point? If you've acquired 0%, so I got a guy in underwriting right now. Now he did have one policy, but man, just a fraction, multiple 6-figure annual cash flow, father of minor still, so much potential ahead of him, and just so underinsured, so undercapitalized too, at least in a private fashion, which is why we're designing, IBC style policies. But like, none of it, from my perspective, is where it could have been or should have been. I suggested that it be different, obviously, and he got on my calendar, and he's in underwriting, so he's about the business of it. But what I'm saying is put it into play, and I started this conversation by talking about me getting another policy on myself as well. It's because, well, I'm that much further down the road, and I've been intentionally implementing this concept for over a decade, and I still realize, like, what, have I waited too long to up my game? Have I been this slow in leveling up, my own capacity? My goodness, Jesse, get with it, But again, when you know better, you can do better, and when you do know better, we'll be about the business of doing it, right? Okay, so we've talked some about the contracts even. What about y'all? Anything else as it does regard? Well, no, again, I'll share another thing that I do. So when I design a policy for my clients, I do want that policy to accomplish something for them that they have told me is again, I don't tell people their numbers. I don't tell them their priorities. I just want to hear that information. Hey, where are you going? How fast do you want to get there? You're going to tell me. But when somebody, is telling me, well, Jesse, here's what's on my radar. I got these 1, 2, maybe 3 things over the next 12 months. This is what I've prioritized. Beautiful. Can I design a policy to help you accomplish that? Yes, and I do want to. So I'm a believer in having a significant enough of a cash value to leverage in someone's first year, 12 months or less, something that they want to accomplish. Now, it could be as simple and inactive, lethargic, if you want to say it, as not even using a policy loan, but they do want to capitalize a certain amount in their policy because they want to have that for an emergency fund. They want to have that for an opportunity fund that they're building for this 5-year business plan or whatever that they're doing on the side. Whatever it is, so it doesn't even necessitate a policy loan, but I want to be able to check the box to say, okay, when we've designed this policy, we do know that in the first year of that policy, it did something for you. Now, very often, though, of course, it is going to mean that there will be a policy loan, but we know that there will be a cash value of an amount that's available to let them accomplish paying off this thing or paying for this thing or taking care of their business taxes, on a quarterly basis or whatever. But I like designing a policy, and I do design policies that will enable somebody, even in their first year, to do X, Y, or Z, coupled with, everything that I've also already said of, well, but we're also thinking long range. We're also thinking about how much insurance is available to you. And there might be another convertible term policy that's acquiring that. And hey, 2 years from now, the plan is we're going to convert and we're going to have a second whole life policy, et cetera. Right. So that's something that I like to do. So I'm curious, is there anything else from y'all's perspective of when you're designing policies and having conversations with folks that you have in mind in your process when it comes to that? And then, are there any riders that you particularly like? Again, y'all get as detailed or nuanced or as loose as you want, but I'm curious what occurs to you.
I definitely like and appreciate the sense of purpose in the process, right?
Mm-hmm.
I've had some clients that took almost a year before they ever used the policy. Again, it was for a very explicit purpose, so I can understand that. So little understanding of, okay, now I know that I can actually use this for something other than what I intended, and it's still going to benefit me no matter what. But yeah, I definitely like going in with, here's what I want to use this for, and not, you know, someday, but rather, what can I use it for today, and how can I
Mm-hmm.
improve my life with it today? Um, so I certainly have had a number of different situations that have come up that way with clients. I did that personally as well. My first policy, even though it wasn't very large, I mean, I used it within 15 days, and I started the process of knocking out some debt that I had at a bank, and it worked extremely well for that purpose. And it worked so well, I realized I did not go nearly big enough for my system and myself and my family, that I had to expand upon that. So, and sometimes that's going to happen, right? Because we're
Mm-hmm.
our main limitation is what's between our ears, and so we can expand that. Thankfully, we've been gifted that way, that our learning can grow and we can expand. So the key is to keep learning and do that with your agent, do that especially on your own, and learn and grow. And from there, you'd be amazed at what's possible in relatively short amounts of time. But again, start with purpose, and then from there you can turn it into something that maybe you never thought was possible.
Mm-hmm.
And I'll just add to that, if I may, Jesse,
Mm-hmm.
is that I make it a common practice in policy design, particularly in the first year, even particularly in the first month or two, have your prospect or client experience the sensation of taking a loan, even if they may not need it, because I'm of the mindset that if it's like if you show them how it works mechanically,
Mm-hmm.
that could add to their buy-in and credibility of, oh yeah, you know what? I actually, I have this pot of money that I've in premium payments that are now accessible to me. Have them mechanically actually request a loan, or I would help them initially, because a lot of times they just, we need to teach them.
Mhm.
But speaking of policy design, even if they don't need some of that loan that they take, or that they take out from their equity that we've created, at least they get to feel what that means, like, and what buttons that get pressed, and how the money flows back. And they could even just repay back a loan if they don't need it. But in policy design, I think that's something that I've implemented over time. Have them take a loan, even if they don't need to, even if they don't need it. So that means making sure in the policy design and looking at the guaranteed value of the equity, even from day one, making sure that's a number that they can at least access and
Mhm.
experience the process.
Absolutely. That's right. That's a super helpful point because it's tactile. We're
Yeah.
actually touching the thing. We are using it, even if it's just to do it. Yeah, I've encouraged people before. I've even done this coming up on Christmas time. If I happen to be, helping somebody set up a policy, then I'm like, you're going to buy something for the kids. I know you don't have any big plans, for policy loans, but you're going to buy Christmas. So maybe here's a way that you could do Christmas this year. Maybe, whatever the money is that you were going to spend on Christmas this year, take a policy loan from the policy, go do your Christmas shopping, and then just put that back plus 10%, or whatever. No, you pick a number, but just to go through the motions, just to experience what it's like. I mean, we all probably appreciate online banking for its convenience, and we know what that's like and we're familiar with that. So yeah, I love that you brought that up. Yeah, just get familiar with taking a policy loan, even if you don't have to. But there's still even probably something, even if it's as simple as the Christmas gifts that you would have spent money on anyway. Use a policy for that, just to go through the motions of it. You're actually reminding me. I need to make a policy loan today. When we get off of this phone call, I'm going to make a policy loan on one of my policies because we've got some things in motion. It's a busy time of year where things are warming up and we're doing stuff on our property and all kinds of things are going on in our lives. Um, I also thought of another client that I have, y'all, who I've had, for some years now. And when she got a policy, she got one on her and she got one on her son. And from the start, she as hairstylist, she knew that she wanted and needed to do something for retirement, wasn't liking the conventional stuff. A friend referred her to me, and with her policy, her intention and purpose from the start was she wanted an alternative to traditional retirement investments. She loved the idea of guarantee. She loved the idea of legacy. Loved the idea of the death benefit dividends. All the features really essentially of what a policy could do. And now, having been a client for some years, has taken a policy loan or two, but has paid significant premium into this policy for some years now. Also started one on her son, who is approaching college age now, be there soon. But again, she wanted some kind of an alternative to what's conventionally out there. Didn't want to do the 529 route. Love the optionality, from a well-designed policy. So she started one on him. Again, significant premium. So yeah, I'm not here to tell people how to use policies. I am here to say that policy design matters. And again, reiterate, you being empowered with knowledge and the ability to do the things that you want to do in life is really where the rubber meets the road, in my opinion. All right. Any final thoughts, fellas, on what folks should consider, something you wish you'd have known sooner, anything that does regard policy design or anything that we've covered or haven't covered?
You're talking specific to policy design in that question?
Yep. But then you can say anything as broad as you'd
Yeah.
like to, brother.
Um, I would say learn as much as you can. Um, talk to authorized practitioners, make sure you're asking questions. It's really important that you have at least a baseline understanding of how some of the stuff works. As you go into a situation, the more informed you are, the better decision you can make. So I would
Mhm.
certainly encourage people that way. And then understand what problem you're trying to solve. If it's strictly death benefit, sure, we can solve that problem. That's pretty straightforward. But even that can be a nuanced conversation, right? So uh, it's really important that I would just encourage people to seek good sources of information, learn
Mhm.
how some of this stuff operates, and then you can ask the right questions when you get into the actual design conversation. Not that you want to go in and dictate to somebody how you think it should be designed, because that could actually get you into trouble as well. It's more so let's have an open dialogue about it, and that way we can both explain and talk back and forth about, well, why would you want to make XYZ decision? We can have a good conversation about it and ultimately arrive at something that's going to be in that person's best interest. And then obviously, the process is super important. So I always encourage anybody to read, reread, and continue to read Becoming Your Own Banker. There's so much knowledge in there that's packed in so many different ways that it's not something you just read once and you put it on the shelf and you got it. It doesn't work that way. You got to keep reading, rereading, because there's a lot of nuggets that are tied in different ways in that book.
Absolutely. Two things then I'm coming to you, David. I would underscore what Rob said about staying in the Becoming Your Own Banker book. I do. Done it for 11 years, still stay in it. Another resource, though, this is one I'm rereading, How to Buy, and this is very applicable, actually. So I'm glad that I had it on the desk here with me, because I am rereading this, How to Buy Whole Life Insurance, Framework for Becoming Your Own Banker by Mr. Ryan Griggs. You can get that at his website. You can get that also at infinitebanking.org. Another great resource. I'm so glad that he's put that together. You brought up a great point, Rob, is the second thing I'll say, and then I'll defer to you, David, is we are in a world of where now people are going to AI and asking it for policy design and then maybe showing up. So like, you're not going to get in trouble with us. We're not going to slap you in the wrist or anything, right? But it could be to your detriment is what I'm saying. Uh, if you're showing up with something that you're asking AI to design for you, where you're coming to an agent who's already implemented this concept in their life, and you're giving them essentially a restaurant order. Now there might be people out there that are just happy to say, "Yeah, what's your name? What are your, personal pieces of information? How much premium do you want to pay?" That's what you okay, and they're just transacting with you. Go get that if you want that. Seriously, go get that if you want that. But there's something to be said about what Rob said of having an organic conversation with somebody who's implemented the concept in their life, who does bring to bear, years worth of experience personally, and who has been professionally helping different folks all across the country. So just had to say that because I had somebody this week, fellas, another agent say, "Hey, look at this email that somebody, sent me where they're saying, well, I want this and I want that." And we're just seeing, we don't know anything about this person, but we're seeing things in that email. It's like, okay, that could be problematic. That could be very problematic. I bet this person, probably hasn't gotten into becoming your own banker yet. So had to say that since you brought it up. Such a big topic and one we'll probably come back to with AI and everything. All right, David, what do you got for us?
Well, that's definitely a podcast in of itself is implications of AI and the implications for policy systems and buyer beware. Because like you said, Jesse, there's definitely times when someone comes into a meeting and I know they've done their AI research because it's almost like formulaic in the answers that are being fed to them,
Mm-hmm.
in terms of that person doesn't. I think the average person, I don't even think really even understands some like what they're asking,
Mm-hmm.
but they know that they feel like there's an intelligent large language model that's giving them what they think that the tools that they need to then come to professionals like us.
It's like your young child coming home from the government school repeating something that they heard an older kid say, and you're like, "Do you even know what that means?"
Right. Because at the end of the day, it requires the human element of of discourse that AI will only go so far. It won't get into really the more esoteric human elements of a experience that someone will have with us as practitioners. So, you know, I take solace in the fact that I think this is our industry and just financial services and such. I personally don't, there's never going to be a permanent replacement for the human element of 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 what we do as practitioners. So AI does have a place, but just be careful with where you place it. Um, and one thing I would just say is this is what we do is not an exact science. So there's always going to, what I would tell everybody that works with a practitioner or someone that wants to implement this is that there should be regular interactions and regular
Mhm.
check-ins, regular reviews. Particularly in the first few months, I think it's important because you could very, very easily lose in our busy lives that we all lead about why you got started in the first place to make sure that you're keeping on track. So I would tell the audience, whoever you work with, if they're not wanting to continually educate you, continually communicate with you, it doesn't have to be every day. Like that, those are things that I would tell the audience to pay close attention to because, you know, at the end of it is life insurance. It's a very, very it's an important part of somebody's overall mosaic, but just having it in place as a starting point is just a starting point. So there's going to be, that's why I talked about before having the flexibility of a design of a policy that's going to ebb and flow with your life, have your family changing, God forbid that's happening. Just there's going to things
Mhm.
are going to happen. So just having regular communication with whoever you work with, I think is key. And you can tell right away, in my opinion, if someone's going to be that type of person right from the get-go and just pay attention to that. Because there's a lot of flash in the pan that I'm just going to say that you can get very easily seduced on social media or other platforms where someone can say something. It like sounds almost, I don't want to say too good to be true. Just be careful and just get a sense of like interview that person just like they're interviewing you when it comes to the experiences you have in interacting with us or anybody else in the industry.
Well, I appreciate you for bringing that up, David. I've got a recent video that I released on my mistakes over the past 10 years of implementing the infinite banking concept. And one of my biggest personal mistakes, I said, was not having enough intentional conversation myself as a consumer, as a client, with my agent, especially in those first years. Looking back now, that's actually something that I see that I could have and should have done better. And I've encouraged people to do that same. I should also mention some names have been thrown out here. Bruce was mentioned earlier. There's going to be Bruce Wayner from the Money Advantage. Snowboard Joe, Mr. Joseph DeFazio, Joe DeFazio, our good friend, was mentioned. I've got an interview series where David, Rob, and those other fellas and more have been interviewed. So, all that to say, those videos that we've referenced here and those series will be in the show notes along with these guys' contact information so that you can reach them. This has been an absolute pleasure for me to have this conversation with these fellas. My hope is that you do live and leave a lasting legacy. You can find me at durhamtalents.com. Live and leave a lasting legacy. What type of y'all just got to witness the dad stare to my boy right there making racket behind me.
I knew exactly what it was.
I knew you. I knew you would know. These David, you got
That's what
girls, all right?
that's what caps cuts for, right? You can cut these.
That's exactly right. We're tough on these boys, man. Gotta be. Um, I thought about you the other day, actually. I've got one of my boys in the room with me. He's going to be doing his schoolwork, actually, same room that I'm recording in. But we got us an Iron Man watch recently.
Yeah, what do
Yeah,
you got? What do you got there?
I knew you'd have some. I knew you'd have something fancy. I knew you would. But I just got me and my son Jacob and my son Josiah, since they're now 12 and 10. There are certain things that be good for them to be able to tell the time, and good for them to be able to set a timer for some task that they're working on, or run the chronograph on X, Y, or Z that we're doing. Just different things. I'm like, hey, I've thought of some instances where it'd be nice if we all had a watch, and um,
Yeah,
they've started joining me for some uh, start of the morning rituals. Breathing exercise in the morning, and now we got these watches, so it's a fun thing.
nice. I'm sure Rob has a fancy watch too.
He's got something. He's tracking stuff, steps and whatnot, because he's been reporting on his
I
on
just use
his
my
his
phone.
activity. Okay.
Nothing fancy. I have an app that I use, but not a watch.
Man, well, I guess you're not cool like me and David now then.
Nope, definitely not.
Just messing with you. I think we came up with another business idea or two this morning on our drive into the office together, actually, because Jacob's step over here, Jacob. Say hey to everybody. David's going to be really interested in your watch. Yeah, you got to get close, or the virtual. Yeah, he's eating his last bite of bagel, or we grab something on the run.
Let's see. Let me see your cool watch. Nice. Run circles around Jesse.
Right. He said, run circles around me. He'd like to, but we raced on our property the other day, and don't worry, I'll be releasing the footage on a short here real soon. Real
Is
soon.
Jacob getting paid this morning too?
He will be. But yeah, we came up, I think, with a couple of business venture ideas that we'll do this year, just from driving together and talking.
Jesse can legitimately pay his son, right? Like, and there's going to be some tax benefits for that.
Right, right. That's my cameraman. That's my marketing.
Yeah,
Few things, I reckon.
they sound legitimate tax deductions to me.
You guys are hearing me okay? I'm coming through okay?
Yeah.
I'll try and mute my microphone so we won't pick up Jacob's coughing in a second when we're recording. But good, we're seeing each other, we're hearing each other. I know what we should have shown everybody. Jacob, you just come around here. Listen, I want you to knock your stuff. I want you to knock your stuff out, but we showed off our watches. Step over here real quick and let's show off one more thing. This will probably make the extras. This is just insight into the Durhams. We got some cool watches here recently, but we showed up at the office today. And,
Oh, sweet.
yeah. Got my
Nice.
Norse tomahawk, and Jacob has his battle axe. So
Yeah, it goes invisible too.
right, you're an apparition. You're in and out.
Did you guys make those?
No, we didn't make those. We bought
Okay.
them. We bought
Okay.
them, and now we've been brutalizing them with our throw. Jacob's good at throwing that thing.
Is he?
Actually with some
Nice.
distance? Yes.
Cool.
And it's a bigger implement.
Once you do get the feel down, it's not so
Mhm.
bad, especially like when you get into an axe like what you guys have. If you're using like real small stuff, that's a lot harder to do. I feel like the ones that have decent weight proportion, they
Yep.
throw a lot better.
Yep.